Hello guys, and welcome back to Trade to Learn. Today, we'll be resolving a huge misunderstanding between stock indexes and stock exchanges. But before we do this, we're going to have a short quiz on our previous videos. So, if you haven't already, go ahead and watch them. That was all for that quiz, and now we're going to dive straight into stock indexes. A stock index is a grouping of a company's stocks that measures change in the broader stock market, or a sector of the stock market. Some examples of the most famous indexes is the Dow Jones Industrial Average, also known as the Dow. It includes 30 of the largest companies in the US. Next, the S&P 500, which is made up of 500 of the largest companies in the US, including names such as Allstate, Home Depot, Walmart, and more. Finally, the third index is NASDAQ. This index has a high concentration of technology companies. It consists of over 3,000 technology companies, in addition to Amazon, Apple, and Facebook. It also includes the parent company of Google, Alphabet. Generally speaking, in a stock index, every company has a different amount of weight. So a bigger company would have a bigger weightage, and a smaller company would have a smaller weightage. For example, in the Dow, the amount of weight a company has is based on the share price, but in the S&P, it's based on the market cap. Some indexes may use both of these to assign a certain weightage for a certain company. An index fund is also useful for many things. For example, the S&P 500 index is a long-term investment, but it'll also give you good returns. As shown by this graph, over the last 15 years or so, the index has grown by over 100%. Indexes are a great way to look at how the stock market as a whole is performing. But keep in mind, indexes and index funds are two different things. Indexes are a great way to see how the market is doing, but an index fund is a security that you can buy. The next question that may come to mind is how the companies are picked by these indexes. So how are the 30 companies in the Dow picked? The Dow picks these companies based on their market cap. So the 30 companies are the companies with the largest market caps. The S&P 500 chooses its companies based on a variety of things. It has to have a certain market cap, it has to be a public company for over a year, and so on. And as you can see in this list, here are the 500 companies in the S&P 500. And there are the Dow companies, or the 30 companies that are in the Dow. But the NASDAQ composite is an index, but the NASDAQ is also an exchange. And that's why many people get confused, because they're two different things. Now, as you can see, this chart shows all of the biggest and major indexes that are there right now. And you can see over the years, the NASDAQ composite has grown the most, and the S&P 500 has grown the least, and the Dow is somewhere in the middle. Nevertheless, they're all very safe options, and as you can see, they've grown a lot over time. Now we'll talk about stock exchanges. The exchange is the place where the stocks are actually bought and sold. For example, the New York Stock Exchange, also known as NYSE, is the biggest and most famous stock exchange, and it's headquartered on Wall Street in New York. That was all for today. We talked about stock indexes and stock exchanges, and keep in mind, stock indexes are a great long-term investment as they're very safe because each company has a different weightage in that index. So if you're somebody who's looking for long-term investments, this is a great way to have a safe long-term investment. That was it, and see you next time!